as the market has pulled back over the last couple of weeks, has given investors some really interesting opportunities in phenomenal businesses with long-term 10x plus potential. That's what I'm looking for at Asymmetric Investing. I think there are 5 stocks with that kind of potential. I have either bought these stocks already in November or plan to buy them before the end of the month. So that's what I'm going to dig into today. I'm going to put each one of these tickers in the timeline below. So if you want to fast forward to any of those, feel free to. But if you want more from me and all my research in all of these asymmetric stocks, there's 23 stocks in the asymmetric portfolio right now. Check out Asymmetric Investing. There's a link on the screen and a link in the show notes. I think you're going to love what you see there, and you get my market-beating portfolio. That portfolio includes stock buys every single month. That's what I send out to my premium members there, and that's performance that I track every single week. So doing everything transparently there. Love to have you as part of that community if you want more of my investment research. And I also want to thank this video sponsor, Fiscal AI. I'm going to use Fiscal.ai throughout this video, but if you want to check out this platform based on what you see here, go to fiscal.ai/ASYM. They'll give you 2 weeks for free and they give you 15% off if you decide to become a paying user like I am. Let's use Fiscal AI to look at one of my favorite stocks. I've talked about this a number of times already in November. That is On Holding. This is all of the numbers that we don't have. The third quarter numbers actually incorporated here. So these valuation numbers are actually even a little bit better. Enterprise value to sales is going to be potentially even under 3 right now. That's for a company that's growing revenue at a compound annual growth rate of 42%. The most recent quarter was growth on a constant currency basis of 34%, and they're expecting 34% growth for 2025. So just phenomenal company right now. But let's look at the long-term chart. And these are all trailing 12-month numbers going back to the September 2022 quarter. But I want to just show a couple of things. One is the consistent revenue growth. You can see that their revenue growth, I can actually add this in here. This red line is now their revenue growth rate. And like I said, this doesn't include the most recent quarter, but we are going to have over 30% growth on a constant currency basis in 2025. So that's just phenomenal growth for a company that is reaching scale. They're also doing that with extremely good margins. In orange, you have the gross profit margin. Now that is going to be healthily above 60%. That shows their pricing power in the market. It's exactly what you want to see from a shoe and apparel company. You also have phenomenal operating margins. So you're getting operating leverage from the business. And there's going to be limits to that because they do need to spend money ahead of sales for things like sales and marketing, for building out inventory. Usually it's very difficult to be very profitable being something like a shoe or apparel company if you're growing at 30+%. But On Holding has been able to do that, and they're generating positive free cash flows. These numbers are all in US dollars, but you can see that about $350 million in positive free cash flow for the trailing 12 months, or at least as of the second quarter. So you put all of these operating trends in with the fact that the company is trading at a really reasonable valuation. Like I said, enterprise value to sales is about 3 right now. The price to free cash flow, 26. On a forward basis, the price to earnings multiple is about 25. All of these are really reasonable valuations for a company that's growing at 10, 15%. But for a company that's growing at 30+%, these are just no-brainer prices. And you can see that the market, for some reason, just doesn't like where On Holding is going right now. Since early this year, stock is down about 45%. And shares are still down. Let's just look at the year-to-date numbers and go to percent change. Shares are still down, even after a pop on Wednesday, down about 24%. So the market clearly thinks that there's going to be something negative coming from On Holdings, but that hasn't happened. Consumer spending is not slowing down, at least at the high end, and that's really what On Holding is serving. So I think the risk reward here is just phenomenal for investors, a stock that I plan to add more of in November. Next up is another beaten down company. That is Duolingo. And look at this. Duolingo shares are actually down about 63%, 64% from their high just as recently as May. So not all that long ago. What is the market thinking that is going on with Duolingo? Well, the market thinks that they're going to be disrupted by artificial intelligence. A bunch of artificial intelligence tools have come out that make it much easier to converse with people in other languages. So is that going to mean that people are going to stop learning languages? I don't think that's going to be the case. And really what Duolingo is doing is serving the people who are trying to learn languages to get jobs. That's one of the things they talk about in their conference calls, in their presentations to investors. This is really a functional tool. It's not about having a conversation when you go on vacation. It's about talking to the person when you're on vacation who maybe needs to learn English. That's really the use case for this product. I don't think that's going to be disrupted by AI. This is going to be augmented by AI. And actually, Duolingo is one of the biggest token users from OpenAI. And that's because they're doing actual conversations with people in artificial intelligence. So as you're learning a language, they have an AI that you can actually talk to and that will talk back to you. That's a great use case for artificial intelligence. That's going to help grow Duolingo's business. So let's look at what some of the trends are for Duolingo. What I pulled here is all of their trailing 12-month numbers going back to the September 2020 quarter, so 5 years. And you can see that the revenue growth rate, look, a company that is growing this fast and this consistently just shouldn't be ignored by investors at a 45% compound annual growth rate. And that has continued in the most recent quarter that was just reported last week. That actually caused the stock to drop. But I think that was a real opportunity. You also see operating profit. So obviously operating margin is improving as well. That profitability is improving. Part of that reason that's improving is because you're getting growth in daily active users and monthly active users. So daily active users is actually in orange, that it's now 50 million people who are using Duolingo every single day. And the monthly active users now up to 135 million people. So one of the things that management said in their conference call is that they're actually pushing for more engagement and less towards monetization. There's kind of these levers that you could pull in a business like Duolingo's. You get energy units as you use the app. So if you give fewer energy units, it will actually entice people to upgrade faster. But if you give them more energy units, they're actually going to become more engaged because it's actually free to use the app. So it's really a balance of, do you want to push on revenue right now, or do you want to grow the business long-term by growing this monthly and daily active user number? You can see that the sequential growth is absolutely phenomenal. There's more than 3 million people that were added to the daily active user roles just in the past 3 months. And this gets to what the market didn't like about the most recent quarter. This is total bookings for each quarter. And you can see that this growth rate is just not very high right now. And that's partly because management is not focused on increasing their bookings number. This is going to be basically the prepayment when you pay for a subscription. If it's a 12-month subscription, they're not going to record 12 months of revenue right away. They're going to have a month of revenue and then 11 months of bookings. That's the way the accounting works. But this is not necessarily a red flag as long as the number of users continues to increase. And that's exactly what we see with Duolingo. And the stock trading for a pretty reasonable valuation given the momentum that we have in the business. So a $8 billion market or enterprise value. They have about $1 billion worth of cash on the balance sheet. Price to earnings multiple on a forward basis, 49. I don't know. I think that might actually underestimate the company's ability to turn revenue into profitability, but their price to free cash flow on a trailing basis, 25, forward basis is 20. That's pretty phenomenal numbers, a pretty phenomenal valuation for a company that is growing as quickly as Duolingo is. Now, if there's disruption coming to Duolingo's business, people don't need to learn languages anymore. Sure, that would hurt the business long term. I just don't think that's the case for the people who are actually paying for Duolingo. They're either doing it as a hobby, that's not going to go away with artificial intelligence, or they're doing it because they want to move somewhere else or they want to get a job in a different language. That's a very different use case than going on vacation, which is the kind of thing that investors and the tech community are doing with artificial intelligence language. I think the future is still bright. The real opportunity is moving in really beyond languages to more learning curriculums. So they've added math, they've added chess, but there's lots of different educational areas that they could add to the business. I think this is much more of an education platform than it is a language business. That's the real upside for Duolingo. So I think the risk reward here is just phenomenal for investors. Another great risk reward, Hims and Hers, now under $40 per share. That is just crazy for a stock that used to be over $60 per share, and I think has a phenomenal valuation. 3-year compound annual growth rate, 70.7%. Price value to sales, just 4. That is a very, very low multiple for a company that is growing this quickly. And like a lot of the businesses that we've looked at already today, this is again a business that is growing consistently and showing operating leverage. These operating profits are increasing as growth increases. That's exactly what you want to see from a growth business. Now, Hims and Hers has gone through a lot of volatility with the weight loss business, with GLP-1s, they're compounding. But the future of Hims and Hers is being a healthcare platform, a place that you go to answer healthcare questions. And I think what we're going to see, even potentially over the next 24 hours, they're going to have an announcement on Thursday. They're going to be entering longevity. A couple of things that they're going to add there. They're going to add full testing. So you're going to be able to get testing for a number of different conditions. We'll see what that looks like, what the pricing looks like, what margins look like. But that again expands the market and the things that they can serve to customers. They also bought a peptide facility recently, so that's another solution they can bring to market. I think there's a lot of opportunities to grow. People really get hung up by GLP-1s. I don't think this is a GLP-1 business at all. This is a healthcare business. This is a company that's going direct to consumer, that's disrupting the way that we think about healthcare. And that is a growth business long-term that has an opportunity that's measured in hundreds of billions of dollars, not in tens of billions of dollars. So if you look at the company's market cap right now, just $9 billion, ton of growth runway ahead for hims and hers. We saw how quickly they expanded into weight loss, started with ED, then you have hair loss. But in the future, this is going to be a company that we could go to answer a ton of different healthcare questions. They've added at-home testing, but as they expand those services, you're going to be able to treat more and more things. You're able to do that all from the comfort of your home, potentially even for lower price and better access than you get with a traditional doctor. That is the real disruption, is thinking about healthcare completely differently. That's what Hims and Hers is doing. This is why this is one of the biggest holdings in the Asymmetric portfolio. I think this company doesn't just have 10x potential over the next 10 years. I think this has 100x potential over the next 10 to 20 years. So long growth runway ahead for Hims and Hers. Look for this to be a company that still is very volatile, but when the stock drops like we've seen recently, these are real buying opportunities for investors. Third is Uber. Let's keep things simple. We need to move around. Uber is making that easier, and they're expanding into more markets, not only food, but also all kinds of things that you can buy, partnering with retailers like Costco and Best Buy. So now moving into that shopping market, I think this is going to be a phenomenal addition for them. But the real 10x opportunity is in autonomy. And that's with the partnerships that they have with all kinds of autonomous companies, from Waymo to Volkswagen to Baidu. They have tons of different companies that are coming to market, and they're really trying to commoditize that supply. But let's look at the business as we see it today. Market cap of nearly $200 billion. So a huge business, not necessarily as easy of a 10x once you get to that size. You just get to the law of large numbers. But the price to earnings multiple, let's look at it on a forward basis. Take out some of those one-time things, 27.6. Enterprise value to sales is just 3. And again, this is a company that's growing high double digits per year. So the business continues to expand. They continue to add riders or users. They continue to expand basically the wallet share of that spending with those users. And I think that is only going to increase as we have more autonomous rides. But let's look at some of their basic financials. So you may be sensing a theme here: consistent revenue growth and operating leverage for Uber. You can see that this growth has picked up. This is going back to the pandemic. So let's take some of that out of here. We'll go back to just the December 2022 quarter. Compound annual growth rate is 17.4%. And their operating margin has gone from negative to positive over that period of time. Their user metrics also continue to improve. Total trips growing at about a little over a 20% compound annual growth rate. And their active users on the platform growing at about 14% per year. So they're growing the number of users and they're increasing that usage per user. That's exactly what you want to see for Uber. Now, this is a platform company. I actually own shares of both Uber and Lyft. I think they're just a different risk reward. Lyft is a little bit smaller company, bigger upside potential if they do take some market share. But Uber is the big game in town. They are the aggregator of demand. As autonomous vehicle companies need to get products to market, they're going to look for where we going to be able to unlock demand and unlock profitability for these autonomous fleets from the get-go. Uber is going to be a phenomenal partner for that. That is going to mean more supply in the market, lower cost supply per mile, and actually easier, safer rides for a lot of people. It's going to be so much easier for a lot of people to travel if there's not someone sitting in the front seat with them, if they're able to just lock the doors and sit in a car by themselves. I think that opens up another huge market for them. And when a ride goes from $2 or $3 per mile on average for Uber to potentially less than $1 per mile, that may make sense for a lot of people to have fewer cars or maybe even no car in their garage. I think Uber is a 10x stock over the next 10 years. And this is one that I'm just going to continually add to the portfolio because I think they're just going to keep compounding this business over time. This is one of those companies that we're going to look up 10 years from now. It's going to be one of the best performing stocks on the market. And it's not going to even seem like it's all that bunch of a surprise because it happens so slowly. Finally, another huge winner for asymmetric investors recently. This is a really surprising one. Since April, shares are up almost 100%. But Alphabet was really waiting in the wings, and we could really see this coming all along. They're a leader in artificial intelligence products. They're a leader in artificial intelligence models. They're a leader in distribution of AI. And they have one of the best monetization businesses in all of technology today. You add all that together, and this is a phenomenal growth company that is not, I don't think it's going to be disrupted by AI and companies like OpenAI and ChatGPT. I think it's actually going to take more market share and be an even bigger player. But let's dive into some of the numbers. Price earnings multiple, not quite the value that it was a couple of months ago, but is still under 30. Compound annual growth rate is in double digits. So that's actually increasing over the past few quarters. Market cap, about $3.5 trillion. So huge company, but this is going to be the one stock that we talk about today that's going to be a little bit safer than the others. Google, Alphabet, not going anywhere over the next few years, even if we do go through some sort of a downturn in the market or the economy. Let's look at the core business. I'll get to the Google Cloud in just a second, but what this is their core business. So Google search is in blue, YouTube is in orange. This is just YouTube advertising revenue. Their subscription revenue actually falls in this green segment, Google subscription platforms and devices. And then purple is Google network revenue. Google network is kind of the declining business. It's the ads that you see all over the internet that publishers would put on their website. It isn't people going to Google search. That falls into this blue category. But you can see that these businesses are all growing consistently, all growing in double digits, except for the network business. And even Google search has actually accelerated their growth over the past few quarters. That's showing you that this is not a disruption story. This is actually a company that is getting stronger as artificial intelligence is being ingrained in the business. You're also seeing a lot of operating leverage. So operating income continues to increase for this segment. But the real growth story for Alphabet is in the cloud. I think this chart is the most interesting. This goes back 5 years. So you can just see the compound growth rate for Google Cloud growing now in excess of 30%. And now these margins are not just moving into positive territory. These are really starting to be pretty good margins, 20% gross margin in excess of that in just the most recent quarter. But these are just trailing 12-month numbers. But Google Cloud is one of those businesses that I think is still underestimated by the market. This is the same infrastructure that Google Search has been built on. They're bringing this to artificial intelligence. So you have TPUs, you have all their distribution, all their fiber that they've laid all around the world that they're giving access to customers, and they're willing to pay for that. So if you're an AI developer today, if you're a company like Anthropic, you're actually using Alphabet's data centers along with using other companies. That didn't used to be the case. AWS used to just be the default. That's not the case in artificial intelligence because you do get access to differentiated products, differentiated distribution through Google Cloud. So another phenomenal differentiator for them. This is just a stalwart company. I think when you look at the valuation and the upside potential with Alphabet, there's a lot to like with this company. This is just going to remain a big position in the portfolio for the foreseeable future. So the 5 stocks we went over today: On Holding, Duolingo, Hims and Hers, Uber Technologies, and Alphabet. Let me know which one of those stocks is your favorite. And like I said, if you want more from me, check out Asymmetric Investing. My newsletter is a link on the screen and a link in the show notes. Love to have you as part of that community. I'm buying stocks once a month and that following that portfolio. And that portfolio has beaten the market by a really wide margin. So let me know what you think in the comment section below. Thanks for watching, everybody. We'll see you here next time.